Good afternoon, ladies and gentlemen. The time is now 1 p.m. and we will now begin today's broadcast. Welcome and thank you for joining us for today's session, Post-Pandemic Planning, Preparing Your Business for What Might Be Next. Please be advised, Markham LLP, Markham Technology, and McDonald Hopkins have prepared these materials as part of an educational program. The information contained herein is of general nature and is not intended to address circumstances of any particular individual, entity, or case. While every effort has been made to offer current and accurate information, errors can occur. Furthermore, laws and regulations referred to in this program may change over time and should be interpreted only in light of particular circumstances. The information presented here should not be construed as legal, tax, accounting, or valuation advice. No one should act on information without appropriate professional advice after a thorough examination of the particular situation. My name is Michelle Spadaro, and I am the event host for today's program, and I will begin with a few housekeeping items. If you are experiencing any technical or audio difficulties throughout today's broadcast, please feel free to reach out directly to me via the chat feature located on the right-hand side of the WebEx console. To enable this feature, hover your mouse near the bottom of the WebEx console until a floating toolbar appears and select the icon with the chat bubble from the menu. If you would like to submit a question during today's broadcast to any of our speakers, please do so by using the Q&A feature. To enable this feature, hover your mouse near the bottom of the WebEx console until a floating toolbar appears and select the icon with the 3 dots and select Q&A from the menu. Additionally, today's broadcast qualifies for 1 hour of continuing professional education and continuing legal education credit. Throughout the session, you will be prompted to complete a learning checkpoint polling question. Please be sure to respond to each of these questions in order to qualify for participation. To enable the polling feature, hover your mouse near the bottom of the WebEx console, the floating toolbar appears, and click the icon with the 3 dots and select polling from the menu. I have just opened the first checkpoint poll question. You see this opening on the right-hand side of the console under the speaker's name. There are no right or wrong answers to any of these questions. Please just select one option in order to log your participation. Each question will remain open for 2 minutes, and you will not be able to answer a checkpoint question once the poll is closed. You will be prompted 3 additional times throughout this session with a brief announcement at each checkpoint. Lastly, please note today's session will be recorded and made available for on-demand at Markham LLP following today's broadcast. I will turn the session over to Gary Rosen, who will introduce our speakers.
Thank you, Michelle. Our speakers for today are myself, Gary Rosen. I'm the New York City practice leader and partner in charge of the Valuation, Forensics, and Litigation Support Group for the New York region at Markham. John Heller, a director in our advisory practice that specializes in bankruptcy. We have Mark Carmel, who is a member of the Business Restructuring Services Department and co-chair of the Litigation Finance Practice Group at McDonald Hopkins. And we also have Michael Kazaka, who is a member of the Business Restructuring Services Department at McDonald Hopkins. Those of you that are not familiar with McDonald Hopkins, they're a Midwestern-focused firm with Midwestern values that have a national reach. They have clients throughout the 50 United States, as well as international clients. Markham, those of you that are not familiar, is a number 15 ranked accounting firm, consulting advisory with 39 offices domestically and 6 in China, Grand Cayman, as well as Ireland. When we originally started this seminar, we entitled it Post-Pandemic Planning, Preparing Your Business for What Might Be Next. And nobody would have thought in 100 years that we'd be sitting here today talking about, in the middle of the pandemic, the current situation. But we think that the information that we have here today is going to be beneficial for all the attendees, and we think that it'll be very, very useful on a prospective basis. So without any further ado, what I'd like to do is just briefly go over the agenda and table of contents for today. We're going to be identifying financial and operational distress. We're going to be understanding one's fiduciary duties during this situation. And we're also going to be considering alternatives to address resulting challenges. So without any further ado, I'm going to turn it over to John Heller from Markham to take you through the first section of this webinar. John?
Thank you, Gary, and hello, everyone. So the first slide here, we're going to jump in. I have a couple, we'll call them just fact patterns or case studies, and hopefully you don't recognize yourself in here, but you may recognize certain customers, or if you do recognize yourself in here, that's what this seminar is about. So sort of the first fact pattern looks at is what we're going to call an insolvency fact pattern, where we have a manufacturing company that pre-COVID went ahead and went on a growth and a buying spree while the money was nice and cheap and still is. But and then they went ahead and they also, as part of that, going ahead and buying different companies and acquisitions, put out the capital expenditures. They leveraged themselves up very well, they are unable to take any more. They're at the top. They're at around 80% of their asset-based lending. They don't have any cash in reserves, and additionally, management is no longer equipped, has not been through a downturn in the last 10 years, and as a result, people are fairly frustrated, and key personnel are looking at other opportunities. So this company is, again, it's highly leveraged with a ton of acquisitions that need to be can be divested, and so they're going to need they're in an insolvent situation and going to need some help. Let's go on to the next slide, Gary, and talk a little bit about that. Okay, so here's a little bit, and I went ahead and threw some numbers in here on this one. This is I'm going to call this one a liquidity example. This is a company that right this second, one of their customers went ahead and a significant customer has filed for Chapter 11. That customer owed the company $10 million. And that $10 million was 25% of the company's total receivables. So the company had receivables of $40 million. Now they only have collectible receivables of $30 million. Additionally, the company was in a lawsuit, lost the lawsuit, and has lost an appeal. And they now have a $10 million judgment against them that's contemporaneously due. Well, on the asset side, they have $10 million in inventory and $5 million in cash. Also available to them is $5 million on a line of credit. And then on the other current liability side, they have $45 million in payables. So from a current asset and current liability perspective, this is a company that prior to the Chapter 11 and the $10 million lawsuit had essentially about $60 million in current assets and $45 million in current liabilities. And with the switch, they now have $50 million in current assets and $55 million in current liabilities, and $10 million of a lawsuit they need to immediately pay with only $10 million in cash. So they have a definite liquidity problem. They do have some below market leases that can be leveraged, and otherwise they're in compliance with all their bank covenants. So this company may be able to figure out some strategies, and we'll go through those on what they can maybe do. So let's talk about financial and operational distress based on those two examples. So I'll refer back to them as we go through them. Okay, so your primary goal and is to maintain your liquidity, whether if you're in a distressed situation, which was number two. So when I'm coming in, or Gary or anybody or any financial professional comes in and we're talking about liquidity, we're really talking about your working capital and your current ratio, right? So if your current assets are less than current liabilities, or if your current ratio is less than 1, you have a liquidity problem, or your customer has a liquidity problem. You can't pay your debts as they come due. In that situation, then we're going to have to figure out some strategies. But that's a liquidity problem. Your solvency problem is a little different. That's your ability to pay your long-term debts, right? And so we'll generally look at your total debt compared to your total assets. If your total debt compared to your total assets is up above 0.7 and is certainly, at 0.8, 70 or 80% of your total assets, asset-based lenders are generally not going to consider you a viable entity to continue to lend against those assets. So hence you start to have some solvency issues. The best way to and whether you're in a liquidity situation or a solvency situation, cash flow forecasting is the most important thing you can do. And so a 13-week cash flow, and whether this is for you or for any customer that appears to be having liquidity problems with you, this is what you want to focus your attention on, is figuring out on a week by week basis where your collections are coming from, where your expenses have to go that week, what payroll you have, and keep yourself cash solvent. Okay, the second thing you need to do is you need to communicate with all your lenders and your stakeholders if you are either in an insolvency or a liquidity position or approaching one. Okay, and clearly your ability to secure additional debt or raise new equity is most viable. If you can make a capital call to solve either your liquidity problem, that will definitely help. Your solvency problem may be solved by capital raising, or it may need some additional restructuring. And you don't want to wait too long to address either situation. Now, I want to talk about some of the indicators, before we go on. So if you're looking at a customer and financially you're hearing things, or yourself, if you're experiencing negative cash flow, if you're having problems covering payroll, if you are needing to lengthen your AP remittance, if your collections are lengthening from your customers, if you can't pay, if you're having problems taking on more debt, or you can't raise more capital, those are pretty good financial indicators that you are in a sort of a turnaround situation. From a customer standpoint, if your customers are missing payments to you, or if they're not accepting any more, giving you any more purchase orders, or if they're ceasing, you're starting to shut down certain of their segments. Those are other indications from an outside view that you may see that some of your customers are having problems. On your supply chain, from your vendors, if your vendors are delaying shipments, or again, if they're shutting down certain operations going forward, that's another indication that they're having some financial issues. Obviously, and then also from an employee, if you're an employee or if you're in the business and you're hearing from the industry that a certain industry partner over there is not covering their payroll, that key employees are leaving, those again, you need to, you should put your ears up and start to wonder about doing business or how you're going to do business with those either customer or vendor going forward. Obviously, there's additional things with COVID-19. The social distancing requirements are putting a strain on everyone. You got to look at, to the extent if your customer or your vendor are missing any contractual obligations, or if you're starting to have to miss those. Again, those are people see those as good legal indicators, as well as evictions and foreclosures. Coming back.
John, I'm just going to interject for a second. I think one of the things that's important to take away from this also, what John is talking about, is that you can't look at this in a vacuum. What you've got to do is you've got to look at the macro as well as micro attributes that affect your business, not only internally, but how the world is changing, the competition is changing, and what impacts those will have on you. I think Mark also had a comment you wanted to raise on this slide as well.
Yeah, I think this is Mark Carmel from McDonald Hopkins, and I certainly appreciate being on this webinar and having the opportunity to speak with folks that interact with both Markham and McDonald Hopkins. I think as I look at the last point that John made on the slide 9, waiting too long to take action, I think about the 3 most important factors for addressing distress. And one of them is doing it in a way that you maximize the amount of liquidity that the company has. Now, obviously, we're talking about distress, and so by definition, you're not in an ideal liquidity position, but that feeds into the second point, which is time is the second factor that's most important, partly because time is money, and so the earlier you do, you recognize that there's distress that has to be addressed, the more money you have to address that, and partly because it takes a lot of time to address the distress, both in terms of identifying liquidity solutions, as John identified, and in terms of working with constituents. And then the third thing is credibility. So it's, you want to maximize the amount of liquidity you have, you want to maximize the amount of time you have to address the problems, and you want to maximize the amount of credibility you have with your current constituents, be they lenders or suppliers or customers or investors. And to do that, you need to have the right team in place to address that, which is both an internal team and an external team. You have to have information available to share with folks, which I know John is going to address in a minute, especially as it relates to information about the amount of liquidity that the company has, and you have to be honest. And one of the attendees asked a question about tips on approaching investors during times of financial distress, and I would kind of fall back on these 3 things, which is approaching those investors sooner rather than later, approaching them with an understanding about what your liquidity situation is, and having a credible explanation for how you intend to move forward, including how you intend to get more liquidity. And so we'll talk about these things as we go through today's presentation, but communication with all of the constituents is super important, both in terms of fulfilling fiduciary duties, which we'll talk about, and obligations that officers and directors have to the organization, but also in terms of addressing the distress that they may be encountering, or distress issues that they may be facing because they have customers or suppliers who are facing distress.
Thank you, Mark. In fact, we just got a question asking for tips on how to address and deal with the investors. So maybe we can answer that and keep that in the back of our mind as we go along, because right now we have another CPE check-in slide coming up, CPE CLE Learning Checkpoint 2, and you'll see it on your right-hand side. What is your favorite fruit, I should say. So I'm going to answer that myself, submit it, and John, I'm going to give this slide back to you with the cash flow analysis.
Okay, so and let me just address some of Mark's comments to everybody. One of the things, and the reason I want to differentiate between liquidity problems and solvency problems, right? Solvency generally shows up as, you see it, the liquidity, but you already have a solvency problem. If you're just hitting a liquidity problem, those are things that can be worked out generally in the short term, 60 to 120, 150 days. You form your cash flow, you make your plan, you go look for whether you can get additional capital or what other sources of funding you may be able to raise, whether you're going to factor some receivables, whether you're going to do some short-term things to get out of the liquidity crunch. Those same things, when you're in a solvency situation, you generally also have the liquidity issue too. You have to solve that liquidity issue. You have to get your 13-week forecast built, and it's a rolling forecast. It's constantly changing as things are changing in the world. And more importantly, you have to get that liquidity back, because to solve a solvency situation, the liquidity has to be there in order to address and to get everybody teed up with you. They know your plan, and then you can. And we're going to talk about some of the solutions to the solvency problem in a few minutes. But the liquidity problem that has to be solved. And again, sometimes it's bringing in new partners. Sometimes it's just extending the supplier. Sometimes it's just getting them to work out and say, listen, we understand you have a problem. You're not going to be paying us on 30 or 40 days. We're going to extend you. If you can get your major suppliers to extend you to 60 days and understand that, you can a lot of times work yourself out of liquidity issues.
Great.
So let's flip on to the next slide. Okay, which I believe I've addressed a little bit, but let's talk about the core business a bit, right? So during the pre-pandemic, a lot of companies were in a growth or a buy mode, and they've gone ahead and vertically and horizontally gone ahead and integrated certain of themselves suppliers, and essentially they're not. What we generally find, or what I have found, is that those integrations both are sucking a lot of cash flow, causing a lot of cash flow problems, and because they're not part of the core business. So this is a time to come back if you're having solvency problems, to come back to your core, to go to the thing that you were good at, the thing that was making you profitable, whatever that was, and to divest those other departments and businesses that are no longer core. They might have added a little bit to your bottom line at some point, or maybe in the future, but you can't be proud. You have to take care of those and get the business right-sized so that you can move forward. Obviously, I've already discussed the vendor management, figuring out who your key vendors are, and working with those and all your vendors. But I think everybody would say that most vendors are key vendors, but there's a handful of vendors that you must have, and generally there's some alternatives for some of the other vendors that you may have. Then you have to figure out if I am in a more than a little bit of a illiquidity situation. If I'm truly in a insolvency situation, do I need outside help? And let's move on to the next one, Gary.
Great.
Okay, so at this,
I was going to say,
I believe I'm turning it over.
Yep, you're going to be turning it over to Michael Casca and Mark Carmel from our friends from McDonald Hopkins. So without any further ado, we're going to let the two of them share with them their expertise that they have. And I'm going to also give Mark the ability to give the slides to you, Mark, so you can go at your own pace.
Sounds great. Thank you both. So we're going to start by focusing in general on the concept of fiduciary duties. And this is a concept that is confusing and ever changing, and generally is the state of the law is created by different situations being presented to different judges in legal cases, which frequently involve significant amount of distress. And then as those judges make determinations, they write opinions, and those opinions actually help develop the state of the law. And so over the course of my career and Michael's career over the last 2 decades, the state of the law has changed, and in general is favorable and provides protections to directors and officers, and in general prevents directors and officers from becoming personally liable for decisions they make but that's only so long as the directors are acting appropriately. So in essence, fiduciary duties help explain how the executives and the board of a company should act in a way that is protective of the company. And if they act in that way, then the directors and officers are unlikely to be found responsible financially for the decisions they made. And we'll get, we'll dig into this, but the directors and officers have fiduciary responsibilities to the corporate entity. And that's because they're making decisions on the corporation's behalf or the company's behalf. And it could be a corporation, it could be a limited liability company, it could even be a partnership. And what different organizations or type of entity it is, and where, like the actual state in which it is organized, will determine what the fiduciary duties are and the extent to which a director or officer may be liable for decisions that the director or officer made. So because most people organize their entities in Delaware, this presentation is more focused on that. But whenever we're representing clients, one of the first things we do is figure out what type of corporate entity or what type of entities we're talking about and which states they're organized in, and do research. But primarily, the fiduciary duties that people are focused on are the duty of care and the duty of loyalty. And as we get into the future slides, we'll dig in a little bit on that. There are other duties that are recognized, certainly in different states, but for the most part, those other duties are incorporated into the duty of care and the duty of loyalty. And the last point on this slide is basically what directors and officers have to do is act in good faith and do what they think is for the benefit of the corporation or the entity that they are advising. And so the first duty that we're focusing on is the duty of care. And there's a lot of different ways to think about this because, again, there's a lot of different legal cases where courts have addressed whether a director or officer is exercising their fiduciary duties when they've made decisions that affect a company. And as those different judges make rulings and make decisions, they kind of frame things in a different way. But all of this says about the same thing. So like in the first bullet point here, we talk about the fact that directors and officers must act in good faith with the care that an ordinarily prudent person in a like position would exercise under similar circumstances, and reasonably believing what they're doing is in the best interest of the corporation. So as an executive, whether you're an officer or a director, as you're thinking about decisions that a company is making, so those decisions should be as kind of going back to the stuff that John talked about. If you're thinking about shrinking your business, going back to your core, maybe selling off non-core assets and running a marketing process or selling them to someone that you know, thinking about how to respond to COVID, thinking about when you have a supplier that's not supplying, or moving your supply chain from out of the country to into the country or to different countries. All of those are decisions that you're making, and when you're making them, you're required to follow the duty of care. The second bullet point here, talks about the fact that you need to be informed of all material information that is reasonably available. So it's not all information. You don't need to track down every last fact, but information that's reasonably available. You have to carefully consider it and do so with requisite care. And one thing that's important is when you're exercising the duty of care and making the decisions, you are entitled as a director or officer to rely on reports that are prepared by officers of the corporation or outside experts and advisors. So that's one of the reasons why there's a benefit to hiring advisors to provide you with information, because as long as the process of retaining those advisors was done in good faith, you're allowed to rely on their conclusions. And then the other aspect of this is the duty of loyalty. And this is making sure that when you're making your decisions as a director or officer, you're making those decisions and acting on behalf of the corporation and refraining from self-dealing, usurping corporate opportunities, or acting in a way that's improper and seeking to have your own personal benefits rather than thinking about the corporation. And as you're doing this, you have to be both disinterested, so you can't be influenced by your own personal benefit or advantage, and you have to be independent and free from outside control. And all of this is super relevant because in a non-distressed situation, you're basically, the company is continuing to abide by its contracts. And so you're paying suppliers, you're delivering goods to customers, so they're never going to be upset. And so even though you may have a problem or breached a fiduciary duty, they're never going to care about it because they got what they bargained for. And it's only the equity holders who might think you didn't do as good a job, but a lot of times the equity holders are either the same as the directors or officers or have a direct line to them. But remember, we're talking about a situation where there's distress. And when there's distress, you may have banks that are not getting paid in full. You may have customers who are not getting the supply, and that's going to frustrate their business, or suppliers who are not getting paid. And so they may just try to sue you, but sue the company. But if the company does not have the ability to honor its obligations, then all of those constituents are going to go and look around and see who else they might be able to sue. And the way that they can sue directors and officers typically is based on a breach of fiduciary duties. So it's important to think about these fiduciary duties as you're thinking about the fact that you're working with an entity that may be in distress. So let's go to the next slide, which is...
Well, actually, before we do that, Mark, the next slide, which is the, well, you can roll it, but the next slide is going to be a CPE check-in. I was going to say before we get to the business judgment rule and entire fairness, we're going to see what everybody's favorite animal is. So if everybody can take the pick and submit, we can now move on to the business judgment rule and entire fairness.
And this is John. While we're all checking the box, I just wanted to comment on the duty of care and duty of loyalty and my experience. And my experience tends to be that where officers or directors get in trouble, where I have seen, is in this closely held companies, not in the public companies, but the mid-size and below closely held companies, whereas as was discussed, equity is also officer and director, and while in distress, they forget that their officer and duty, their duty of care and loyalty, come before their duty to themselves as equity, and that's where the issues are. So if you are in that situation, if you're privately held, just be very cognizant of that and what we've discussed here.
Absolutely, and that, John, that's a great point and a good segue into both business judgment rule versus entire fairness standards that courts use, as well as fiduciary duties in the context of insolvent companies. So I'll turn it over to Michael Kaska to discuss that.
Thank you, gentlemen. So after Mark has described all the right decisions and being informed and doing things that follow one's fiduciary duties, there's a corresponding sort of legal shield for decisions that are made in accordance with those duties, and that's the business judgment rule. And as we said at the beginning of this, we're really, we're emphasizing Delaware law. The most sort of case law has been written there. The changes all seem to start there and then sort of spread out to other jurisdictions. But the business judgment rule is generally in effect in virtually every jurisdiction. And this is basically the standard of review for corporate director conduct. And so it's a shield for liability for decision making, and it protects directors and perhaps even officers in the decision making process. And as Mark and Gary have alluded to, and we'll discuss in greater detail on the next slide, the directors continue to owe their fiduciary duties to the corporation even after the corporation is insolvent or even approaching insolvency. When that happens, it's simply the case that the creditors replace the shareholders as sort of the residual beneficiaries of those duties. And, directors, they owe the duty of care to act on an informed basis, a duty of loyalty to the corporation on whose board they serve, as well as a duty of good faith. And so with the business judgment rule, if one satisfies all of those duties, one looks at the business judgment rule of having two components. It limits directors from liability if they act in accordance with it, but it also insulates a court from intervening in a company's management decisions. And so here, as a result, as long as a director is making decisions in good faith and is not interested in the subject matter of the decision and is informed and it actually believes that the decisions being made are in the best interest of the entity, courts aren't going to come in and substitute their own notions of what is or isn't an exercise of sound business judgment, although obviously the facts of any particular case matter. Essentially the approval of, a transaction or some type of major decision by a majority of independent and disinterested directors almost always supports the presumption that the business judgment rule would apply to the director conduct. So even if someone comes back and tries to attack, a violation of this duty of care, in those instances where you have independent directors making disinterested decisions, the rule would apply. So, even hindsight might go back and say, gosh, these decisions that are made by a board were wrong, they didn't pan out as expected, or they could have even caused significant financial losses for the company. Again, that's hindsight, but so long as the director's decision-making sort of falls within the parameters of the business judgment rule, then, even taking on significant business risk that turns out to be disastrous, is going to be protected absent, misconduct or the other sort of negative circumstances or other violations of the duty. So if someone wants to try to bring a claim against a director, for some decision or some transaction that was approved by the board, the burden of proof is on that party who's going to challenge those decisions by the directors. And they're going to need to establish specific facts to rebut essentially the business judgment presumption. And if they can't meet that standard, then, the business judgment rule applies and there's going to be no liability for the decisions made by the directors. But if they can prove some facts, sufficient to overcome it, so things like, the director acted in gross negligence or in bad faith, or the director had some type of conflict of interest as a result of approving the transaction, then the court's not going to uphold the business judgment presumption. So at that point, the burden shifts back on the director to prove that the transaction was entirely fair to the corporation and its residual beneficiaries. Right. So you kind of look at sort of two contexts, and one is, was there fair dealing? And, as a result of the process, the dealing process, did it result in some type of fair price or fair result? And it's a pretty strict standard. And it'll apply to transactions where there's conflicts where maybe a majority of the board is not disinterested, or if board members are going to receive some type of material benefit, or if a director has a financial incentive that ultimately is proven to be adverse to the corporation, or if there's some director that is conflicted and is just sort of dominating board decision making. This kind of goes back to those situations where you've got a majority, closely held business, majority owned, and you've got a particular, director who's built the business and is also an owner and is really trying to push through some decision that may or may not be, ultimately the best for the enterprise, but it may, help him or her in terms of, whatever the ultimate result of that decision making. And that's where these situations get sometimes a little bit hairy. And so, if directors are found to be on both sides of a transaction, or, if they're not looking out essentially for all the residual beneficiaries of the entity. And again, those residual beneficiaries, depending on whether a company is solvent or insolvent, change. But the point is, the directors themselves need to be looking out for folks beyond the directors in terms of trying to, overcome essentially any, if they don't meet the business judgment standard, then they want to show that the transaction was entirely fair. They got to show that they weren't looking out essentially for themselves. And so you got to have a process that, really gives people, you could show, here's exactly what happened, here's what we did, here's what factors we took, how we initiated, how we negotiated, was there counsel on both sides, were we using, how well were parties informed of this? And you really kind of have to be able to lay out the fact that, the process that the board went through to determine, even though there might be some, non-disinterestedness, it still was done fairly, and then it resulted in a price that, the economics of the transaction made sense under the circumstances. And, sometimes folks will, and I know this is, in John and Gary's world, that, they'll go out and either get some sort of solvency opinion, or they'll get a valuation or something, a fairness opinion, something that, that the board can point to and say, hey, notwithstanding everything, this decision was made properly. And although it may have had some impact on a particular, set of creditors, it was still done completely above board. So
Michael, this is John. I just want to interject because, and when I say that, what you just went through. So part of my experience on this is that a board having a regular meeting to make these kind of major transaction decisions, and the documentation to support their decision, that they sought some outside counsel or an outside consultant, they got a report that helped them make this decision, and they put that into the minutes as a reference with the documentation in a formal board meeting. These are things that help support the business judgment rule and keep the directors out of harm's way. Is that your? That's my experience.
Yeah, I mean, again, if you're going to be subject to challenge, you have to be able to present evidence that discloses how the process was done, because the burden shifts back to the director to prove his or her innocence, for lack of a better term. Then you need to have support for that. So undertaking all the steps during the course of the decision-making process by the board for some type of major transaction or major corporate event is important. And so, I know the title of this is, involving, distress and whatnot. So I think, as we said before, and as Mark said, I mean, the fiduciary duties apply regardless of whether or not a company is solvent or insolvent. But there's been, in our experience, Mark's and mine, there's some common misconception out there that, when a company's insolvent, that, the duties are only to creditors. And that's really, as the case laws evolved, especially, starting back in the, I want to say right around sort of 2006, 2007 in Delaware, courts really started shifting. And they basically said, they concluded that the directors of an insolvent company no longer owed a fiduciary duty to the company's creditors, but rather to all the company's residual claimants. It's just a matter of, who steps ahead of whom in sort of the residual value of the company. When the company's insolvent, generally speaking, absent some, crazy scenario that maybe, you saw with what was happening with Hertz or something a few months ago, equity holders are often out of the money. And so really, the residual value is going to go to some creditor group. And so, but the duties of care, loyalty, and good faith are still required, and the business judgment rule is still applicable. But, the evolution of the case law really has kind of shifted. And so, a couple things that I've sort of noticed over the years and have followed in the case law is that, a lot of people talk about the zone of insolvency. So it's some netherworld between a solvent company and an insolvent company. Before, people were saying, well, if you're in the zone of insolvencies, are there other duties? And Delaware law has kind of evolved to say, you know what, there's no really legally recognized zone of insolvency with implications for separate fiduciary duty claims. There's, you're either solvent or you're insolvent, and, the fiduciary duty analysis only applies in either of those two instances. And as a result, another change is that, creditors can't bring sort of direct claims for breaches of fiduciary duty. And they really, need to continue to, understand that, the value of the business sort of just falls through the priority scheme. And so, I think the most important aspect of this is that the business judgment rule is going to apply to board decisions, after the advent of insolvency, even if transactions when a company's insolvent have a disproportional, effect to shareholders or other constituencies at certain creditors' expense, so long as the board's decisions are, reasonably intended to maximize the benefit for all of the entity's residual claimants. So I think we were probably better suited at this point to move along to the alternatives to distress, because it's kind of taking both concepts from both parts of the presentation and saying how practically these are sort of applied in the world and what ways in which companies can use various structures and various processes to sort of get out of their situation or maximize value for their constituents.
Thank you, Michael. This is Mark Carmel again. And before we get to focus on the alternatives, there's just a couple of things I wanted to wrap up on the fiduciary duties. The first thing is on this slide is that there are certain governance provisions that may actually reduce or limit liability for directors and officers. So that could be in the operating agreement if you're if you're a director or officer for a limited liability company, or in the certificate of incorporation if you have an actual corporation. And so, as part of our initial diligence, when we're thinking about fiduciary duties, we think about what corporate documents may be out there and what provisions. Now, this cannot eliminate a problem for a breach of loyalty, but it does address breaches of duties of care. And of course, there's other things that directors and officers should be thinking about in terms of reducing their own personal liability, including director and officer liability insurance, and also the opportunity to secure releases of liability as part of a restructuring process. In terms of the key takeaways, definitely should seek advice from experienced legal advisors, consider all reasonably available information and alternatives. And when we're talking about distress, it's always thinking about what's making the best of a bad situation. And so not thinking about what's the ideal solution, because we're usually past that, but what's the least bad solution. Ask questions, don't just be a passive observer of information, but also you can't freeze and you can't have paralysis by analysis, because not doing something could be as problematic as trying something that isn't the best solution. Certainly disclosing conflicts and recusing oneself from decisions is important. We've talked a lot about the taint from having, not being loyal to a company or corporation when making decisions. Make sure that you deliberate and are prepared to satisfy the entire fairness standard if necessary. So we always like to be in a world in which the easier standard of business judgment is the one that's relevant, but are prepared for entire fairness. Maintain appropriate minutes. This is something that John focused on and is really important. And what is appropriate is, something that requires counsel who is steeped in this stuff to appreciate, and then communicate with constituencies. And it's really focused on the appropriate level of communication, which could be, it's very different in different situations and with different constituencies. So with that,
and Mark, I think that's probably one of the most important items on that page. I mean, communication is key, because many people that when they have the knowledge, they have a better understanding as to what's going on, and they don't let their mind take off in a direction that's not accurate.
Absolutely, that's a good point. And so, Michael, we moved on to the alternatives to address distress. Why don't you very quickly kind of summarize the 5 different alternatives that we've highlighted here?
Yes. Okay. So facts and circumstances matter. I think there's a few questions that one needs to ask about, okay, which of these 5 alternatives, and these are just 5, and there's other hybrids and other things that one can do. I think someone needs to evaluate, to whom is the residual value going of a business? What types of liabilities are out there? What's the risk tolerance for the beneficiaries of the, whatever alternative one takes, and how will they be funded? Who's going to support, any of these processes? And so we sort of have them almost listed, not entirely, but in terms of least costly and perhaps carrying the most risk all the way down to the most expensive, the Chapter 11 process that mitigates, sort of maximum risk. So an out-of-court restructuring is exactly what it is. It can take a bunch of different forms: composition arrangements with creditors, forbearance agreements with, one's lenders. It could be, just simple asset divestitures, debt for equity exchanges, and the like. And then the Uniform Commercial Code, UCC sales, are essentially a process where a secured lender, not necessarily a bank, just a secured lender for personal property, will institute a process after declaring a default to either sell their collateral or foreclose on their collateral. It just depends on the creditor. Traditional banks generally don't like to take back the collateral, but other, alternative lenders or those with different types of debt funds will actually ultimately want to, foreclose and acquire a company's assets themselves. One of the challenges there is all you do is you get rid of any sort of junior liens on the collateral, but all unsecured creditors and other claims are still outstanding. A third is the assignment for the benefit of the creditors. This varies wildly depending on state law. Some states make it like a mini bankruptcy proceeding where everything's outlined in the statutes and you could essentially do a small bankruptcy. Or other states, like the state I'm in, Ohio, has a very limited ABC statute that was, I think, written in the 1950s, and it's run through the probate court, so it doesn't get a lot of play here. The next is receivership, and this could be in state or federal court. And the beauty of a receiver is, put him or her in charge, and with they could either continue operating the business or they could liquidate the business. They're officers of the court, but they generally have control and sort of divest leadership, but it's a way to run a process, sell assets, even though if you're not going to pay all your creditors, you still get court approval, you still have a third party in there who's almost acting in a way like an independent director in terms of decisions being made on how to maximize the value of the business. And then the last is your Chapter 11 bankruptcy, which is the most expensive, but it's the most comprehensive. And, generally, you could either liquidate or sell the business through a 363 sale or reorganize. And a lot of that depends on how much support you're going to get from both your lender and your creditor constituencies. And so we have a little couple slides in the back here that talk about different, burdens and aspects of each. So I'll turn it back over to Mark for that.
Yeah, so there's two slides here. One of them, and it's basically because there's too much information. And in between the two slides, there's the final learning checkpoint. So let's get to that just to make sure that we go through all four.
Yeah, thanks, Mark. So that checkpoint is, what is your favorite holiday? You'll see the answers on the right-hand side. And once you submit it, we'll be able to then provide you certificates for the attendees today. So I'm going to turn it back to my colleagues on the panel, and we can go over the alternatives to address distress.
Yeah, so these alternatives, this is Mark again, these alternatives track what Michael is saying in terms of, on the left-hand side is an out-of-court. In the middle are different processes that are either based on state law or with respect to receiverships, sometimes based on federal law. And then on the right column is a Chapter 11. And there's never a right answer. There's always a what is the best under the circumstances. And sometimes even in the middle of a distressed situation, the circumstances change, and therefore the correct alternative or tool to use is something that changes. But none of these solve the problem of distress. They're just tools to facilitate solving the problem. So generally when someone's facing distress, as John talked about early on in the presentation, there's either some level of financial distress, some level of operational distress, or a combination of the two. And you can't, for example, file for bankruptcy to generate money. That comes from, having a bank or other financial source that's willing to provide you money either as debt or equity. But it may be that the source of capital is only willing to do it if you effectuate, one of these processes. So generally in situations where Markham is brought in as financial advisors and where we at McDonald Hopkins are brought in as legal advisors, we try to kind of build up to this part by learning a lot of information about the company and the constituents and the creditors, and then start to, work with the directors and officers to figure out do any of these tools work to effectuate addressing the financial distress or the operational distress that an entity may be facing, or to help our clients address financial distress or operational distress that one of the constituents that it interacts with may be facing. So suppliers or customers or some other group may be thinking about or contemplating one of these processes, and we help our clients on the finance side for Markham and on the legal side for McDonald Hopkins think about what are the best alternatives in light of all the facts. I don't know, Gary, if it makes sense to see if there's any questions for the panel to address in light of where we are and the fact that there's a few minutes left.
That's exactly where I was going to go. I was going to go to the Q&A and see if there are any questions. We did put everybody's contact information, as you can see on the Q&A slide, so you have everybody's email addresses as well as direct dial phone numbers. I did get a couple questions. Let me just take those while we're waiting to see if any others come in. But we did get some during the event. I believe we answered the first one already. Next one is, when should we reach out to advisors to help us if we're facing distress? Well, I'll speak on behalf of Markham. It's never too early to reach out. There's usually no charge to meet with us for an initial consultation. We can give you an analysis based upon the information you provide to us and tell you the remedies that are available to you. I'll let Mark and Michael speak to the McDonald Hopkins philosophy, but I'm sure it's going to be similar to ours.
This is Mark. Gary, that's absolutely correct. Usually when someone is thinking about when they should be reaching out to an advisor to discuss distress, the answer is yesterday, not tomorrow. And, sometimes we advise clients that it's not the right time, but for the most part, we're advising clients that had they come in a week or a month earlier, here's options we would have had, because going back to the beginning of the presentation, what we're focused on is maximizing liquidity, maximizing the time to effectuate a restructuring, and having credibility, and all of those things are reduced as time passes.
And to add to that, Mark, oftentimes people come into us after they've done something they should not have done. So it takes more time, effort, and dollars to undo the transaction that they did because they thought that it was going to be a Band-Aid for purposes of getting them through the valley that they've gotten themselves into. So then that's good advice. The next question we have is.
But Gary, can I just interject? So
absolutely.
This is John. So we're also, while we're talking about what we should do, I've had in the last month probably 5 different clients of Markham come to me regarding they're not in distress, but they've had a vendor or a customer who has gone in distress or filed.
John, did you read the next question? Because that was exactly the.
Okay, that's the next question.
Go ahead, John. Share it.
And so and so getting involved in those early too, so we can advise you as to what might happen, what your rights are from a creditor standpoint, what it looks like as things go through a Chapter 11. How to file a claim, the things that you can do. Those are also important because there are deadlines involved with those kind of things, and what might happen if you get sued on a clawback, and what your position might be. We also jump in, both McDonald Hopkins and Markham jump in those situations also, and the earlier the better. Sometimes people miss their statutory deadlines, and then there's nothing we can do.
Exactly. So with that in mind, I'm going to thank my fellow panelists. I'd like to thank Mark Carmel, Michael Casca both from McDonald Hopkins, my colleague John Heller from Markham. And I want to end by telling you that our email addresses are here, our telephone numbers are here. Please use them if you have questions. We're willing to answer your questions. And we want to thank you all. Hope you and your loved ones stay safe during these difficult times. Thank you for attending today.
Thank you.